Welcome everybody again to this morning's webinar, and this morning we're going to be looking at some of the legal implications that have been caused by COVID-19 disruption, and we're really privileged to have Amy Harper from Kells with us this morning. Amy's partner at Kells, specialising in commercial law. So welcome, Amy, and thanks for joining us.
Thanks, Mark.
And also we've got Angela Hales, who's the Director at Accounting Professionals. Angela heads up our tax and accounting team. And Angela's going to be sort of giving some insight into the tax implications, again, caused by some of the legal issues around the COVID-19 and the disruption that it's causing. So welcome again, Angela. Thank you.
Good morning.
Alrighty, so as I mentioned, today we're going to have a look at some of the legal issues that we're seeing evolving throughout our client base and in the broader business community in general, that is sort of specifically arising through the impacts of COVID-19. And today we're going to sort of focus on 5 key areas. We're going to look at the impact on sort of contracts and supply agreements. We're going to talk a little bit about the PPSR, which we've touched on in our earlier webinars. Also, getting paid and the debt recovery process, this time more from a legal perspective and what options are available. We're going to touch on some changes in relation to the arrangements for commercial leases and finish off with a quick chat about employees and the Fair Work Act. So plenty of things to get through today. So we'll launch right into it. So as I mentioned, I'd like to welcome Amy to the webinar today. And just with it would be very appropriate that we've got the legal disclaimer here, given that we've got a legal slant to things this morning. So just being mindful that I guess there's 2 disclaimers. There's a tax and accounting disclaimer as well as a legal disclaimer. And it is important that, this is general advice and not specific to anybody's circumstances. So, if you do have any questions or any specific issues that arise out of this, please speak to an appropriately qualified lawyer, or alternatively, if it's from the tax and accounting side of things, speak to us. All right, so I guess moving along, and we'll look at contracts to start off with, and what we're seeing is this sort of increased activity in this area as some businesses are struggling to fulfill the terms of either their contracts or their supply agreements. And just throwing it over to Amy there, what are some of the important issues that we need to consider in relation to our existing contracts?
All right, so it can go on both sides. Both you're unhappy that the other party is not fulfilling their obligations. They may not be delivering on time. There may be problems with supply, with borders, and up to recently, you've got problems with movement of goods, and also international arrangements are being delayed with stuff being left on the docks. So really the first thing before doing anything is to go back to your contract and read it. Because really that sets the scene for what you can do. We don't want to get into a position where you do something purport to terminate, for example, because the other party hasn't fulfilled their obligations, only to find out that it might be due to a force majeure event. Now, force majeure is something that sort of sat at the back of contracts before COVID. Nobody really paid too much attention to it, and now that it's happened, it's an opportunity for everyone to go back and have a look at that little clause right at the back of the contract, which usually allows a party to avoid their obligations as a result of an event that's outside of their control. So a pandemic, a government order that prevents working in a business situation where you are not allowed to supply because factories have closed down, are all examples of where a force majeure may kick into play. In the performing arts space, we have artists that may not be able to perform because the theatres are shut down, or because of the fact that you've got regulations of 4 people per square metre, 1 person per 4 square metres, that you can no longer fulfill your obligations. So that's almost a get out of jail free card there. So if you are concerned that you aren't able to perform your contract, checking out the terms of the force majeure clause may be of great assistance to you. Because generally speaking, for the period that the force majeure is in operation, so if the government order is in place and you can't deliver or you can't perform, then you can be excused from your obligations. The flip side of that as well is that quite often in the contract, it will provide that if a force majeure event continues for a particular period of time, then the other party can terminate. So it's wise to be aware of that position, because you may find yourself, while you're excused from the contract for a period of time, the end result may be that the party can terminate you. And that may not be a position you want to be in. So keeping that communication open with your client or with your customer is definitely the way to go.
So just in respect to those clauses, is it hinging on the government declaring, in this case, that there is a pandemic, and that sort of kicks it in?
It will turn on what the clause says. So it's the drafting. So if it's sloppily drafted, then it may not assist you, for example. So I know back in March and April, we were receiving a lot of calls from people asking to interpret their force majeure clauses because they weren't able to perform. So if it's a clause that allows for outside of a party's reasonable control, then that encompasses a lot of things. They can be quite specific. They can provide that it might be due to a pandemic, epidemic, industrial dispute, war, civil hostilities, those sorts of aspects. So it's really a case of looking at the clause to see whether or not it applies to you.
Yeah. And I guess the other thing that we've sort of forgotten about now, seems so long ago, was the impact of the bushfires,
Yes.
particularly on clients, on the south coast, and whether they're covered by that in some of their contracts as well.
That would absolutely be the case. So if there's bushfire and your storeroom is burnt down, for example, and it's through bushfire, not through your own employee's negligence, then absolutely there's scope for a force majeure clause to kick in.
Yeah. So then what are some of the other things that we should be looking out for in existing contracts?
Well, I guess linked to force majeure is after you go through your contract and have a look at that, it's not all the end of the world if there's not a clause in there to that effect. There can also be what's called the legal doctrine of frustration. So that's where, practically speaking, the parties end up with a position that's so different from what they had contracted to do. So I can give an example in the performing arts space where on a particular day, there was a performer who was supposed to perform, and that venue shut down. So that venue, that performer cannot perform on that day. So in that situation, that's a clear case of frustration, which automatically terminates the contract. So if there's been deposits paid, for example, in advance, that would ordinarily entitle the client to get a refund of their money. We're also looking at small businesses, particularly in the weddings and events and restaurants area, where deposits have been paid for weddings. And it's tricky. It's getting trickier now because of the limitations are lifting. So where it was clear cut and you've got to, cannot do it because of COVID restrictions, say, for example, in Victoria, whereas up here in New South Wales, it just might mean that the event looks slightly different. So it's a case of looking and consulting with your lawyer just to get that legal advice before you do anything. And look, we're being driven a lot by people who may have put deposits down for events or put down deposits for supply when the stuff is still sitting waiting to be delivered and it's well outside of time frame, whether or not in the absence of a force majeure clause, we can go to the point of asserting frustration to be able to end the contract. Okay. So yeah, that's another interesting aspect to be looking at.
And then I guess the other thing that we're seeing a little bit from an accounting side is the impact on COVID-19 on valuation mechanisms and earn-out agreements and the like in contracts.
So I guess, again, going back to that point one is looking at reading your contract. So if you are thinking And we're seeing it. Clients are making decisions because they've been through COVID and they may decide to no longer want to be a business owner. They've just got to the point of reassessing their situation, that just encouraging them to look before they make decisions as to what the valuation is. And if that's a multiple based on revenue in a year that you may have suffered significantly, that you may want to think again, or seek to negotiate with your former partners or your owners to be able to come to an arrangement that is not necessarily strictly interpreted on the contract. So I guess I'd be cautioning there for people who are exiting to, before they might serve a formal notice under their contract, to start the exit, to see what they can do in the way of informal negotiation to try and get to an agreed exit figure before starting, because once you've started that contract, it's difficult to then stop that process from happening. So that would be my comment there.
And then just on the tax, I guess, and accounting side of things, Angela, in things where you've got, a sale contract that's based on an earn-out agreement or adjustments for revenue, what we're finding is that the proceeds that people may have expected to receive aren't going to be the actual proceeds that they do receive, and how that impacts on capital gains tax.
Sure. So when the proceeds change to what was expected, then you actually go back and amend the capital gain in the original tax return that where the sale was. And there's a few things that have impacted that. One, potentially the reduction in earnings due to COVID, but actually some unintended things that came out of COVID too is all the government stimuluses. So you've got the cash flow boost and JobKeeper income that are still income to the business, and is an interesting thing that's come up that is going to require some negotiation between parties. So the capital gains tax implications means that it could be less if your business has suffered in that period, or actually it could be more or the same if you've actually been topped up by the government stimuluses. With the recognition of revenue, both those two government stimuluses have different tax treatments. So the JobKeeper income is income, taxable income, and the cash flow boost being tax-free income to the business.
And what we're seeing with a number of clients that are in the earn-out phase of their sale agreements is whether or not the JobKeeper stimulus money is revenue to the business or not. Our firm belief is that it is. It's actually a direct subsidy for the wages that a particular business is paying. The cash flow boost is a little bit more grey, but there's certainly what we're seeing amongst our client base is it is generating some issues in that space. So we sort of, Amy touched on existing contracts, but if we're sitting down and we're looking at entering into a new, either a new supply agreement or we're looking at purchasing a business, what are some of the things now post-COVID that we need to factor into the drafting of those contracts?
So generally, force majeure definitely is something we should be looking at, and the drafting of that clause to make sure it's wide enough to not just, if you're the party supplying, that it's not just covering a government order, but also the consequences of that order, because there may be circumstances where the government's not shutting your business down, but it may have an indirect impact that results in you not being able to deliver on your contract. The other area is around entering into new contracts. In the franchising space, there hasn't really been the statutory relief that there has been for commercial leases, for example. So while you might have a general force majeure clause, also looking at excusing yourself from particular revenue targets. Commonly, there might be in a supply contract, in a distribution agreement, in a franchise agreement, there may be a minimum gross revenue target, a sales target. So being specific to carve out an allowance for not achieving that target. Commonly, if you don't achieve, there might be a consequence of termination. Trying to water that down in circumstances where COVID or COVID-related events may be occurring, because we're on notice there could be a third wave coming in 2021, who really knows, or beyond. So trying to get excuses there for performance of obligations is something that is going to be valuable for you, because you're not going to want, if you haven't performed because you might be in the personal services space where you have a risk, in home care examples, where you're no longer able to deliver because people just don't want your products because they're scared. It may not be due to government order, but they just don't want people coming to the home. In that situation, having an amendment for the revenue targets might be very helpful for you. So you're not facing yourself with a termination and breach notice in halfway through next year. Same deal with leasing. We've got the leasing regulation that's been there to support everybody, but that's only for leases that's been entered into in April 2020 or earlier. So with that in mind, we start to forward look. Is your permitted use wide enough? If you're a restaurant, does it permit takeaway? I know that we've had clients during this COVID period where the permitted use was too restrictive, and so they were prevented, while there are other people who are able to reskill and be agile and allow home delivery or other options to keep their businesses afloat, that they were very limited and prevented from doing that. So I'd encourage people to look at their permitted use, looking at allowances out of the contract, and your force majeure clauses, and also dispute resolution. I don't never put that aside. It may seem like a softer option, but if there is a contractual obligation to at least get the parties to talk, then that's a good start. And I think I've found that during this period of time as well, that has been helpful, at least trying to start conversations before having to resort to court.
Yeah, and I think for what we're seeing, for the most part, the parties have taken, a real proactive and pragmatic approach to things. I think, particularly earlier on in the piece, there was quite an acceptance on both sides of the contract that yes, this COVID thing was happening. We've never seen anything like it before. We both are depending on each other equally. Let's sort something out. And for the most part, not always, that's certainly what we saw within our client base. And there'll be lots of lessons learnt from COVID-19 in lots of different areas, and some things will change probably forever. And then if we end up getting a COVID-20 or a COVID-21, which could well happen, then we'll be a little bit better placed to deal with that. And I think before, you sort of mentioned on some of those COVID-19 mechanisms that you can build into your contract, and certainly the permitted use is an interesting one.
And also just working out, considering personal guarantees and security. So if you're talking about a contract where you're expecting someone to perform, so this is on the flip side, you're not really the performer, you're the receiver, that keeping in mind whether it's appropriate for you to be asking for personal guarantees for the directors of that company. That may provide you with an additional recourse if the company goes into insolvency, if they're suffering a tough time into 2021. Whether there's alternative security, whether they need to provide a bank guarantee that can be called upon in the event that they can't comply with their obligations. So starting to look outside of also purely the two companies that might be contracting, but looking behind as to what might happen if that company goes under. What security, what other options do I have?
Yeah, and we've spoken sort of at length in previous webinars about the importance of getting paid and cash flow in general, particularly earlier on in April and May when the it was less clear as to how things were going to play out going forward. I guess one of the things that we've also touched on is the Personal Property Securities Act as a tool to add a further layer of protection.
Yep. So for those who haven't come across the PPSA and the register, which is also called the PPSR, it's a mechanism where the law changed almost a decade ago which allowed where you are supplying goods, supplying things, but you're not being paid in advance for them. And that's common, you supply goods and then your customer pays you at the end of the month or the end of the month following. That is called a retention of title. And it used to be the case that was enough, that you could just rely on your retention of title clause in your contract. And if they don't pay you, then you still own the stuff, and that gives you the right to get it back. The PPSA flipped that on its head and made it a two-step process where you still need to have that in your contract. But unless you perfect, or that's the legal term, but if you register on the PPSR, unless you've done that and you've done it within time, then in the event of the insolvency of that customer, those goods are not yours. They're deemed to be the customer's. So it's really important that you register. Now, it's not a hard process. The starting point, I guess it's not purely legal. There's two steps. So terms and conditions, important that you get legal advice and you get adequate terms and conditions to set the scene. In legal speak, that's called attachment. So under the PPSA, you need two things. You need attachment, i.e. your terms and conditions need to be valid and have an adequate clause in them. And you need perfection, which is that registration piece. Registration is not tricky. It's not particularly difficult. We talk our clients through the initial registration. We make sure that we get the categories right. And in terms of cost, you're looking at about, I think it's currently $3.30 per registration. And one registration can cover that ongoing relationship with your customer. So I would suggest to anybody who isn't currently aware of this process and who is supplying goods on the promise that the customer will be paying later, happy to have a discussion with you about that, because what it does is, in the event of insolvency, it jumps you ahead. You've got the protection of your goods because they are deemed to still be yours, and allows you a mechanism to get them back, or if they have been sold or gone, to be able to trace the proceeds to get that money back as a secured creditor. And it's just a necessary thing now. And it's not a case of you having to, every time you sell goods to somebody, you have to register. Usually what we're seeing with our clients is that they will have a process where a customer will fill out a credit application. As part of that, encouraging our clients to check who your client is, who is your customer, is it a trading name or is it actually a company that you can sue if things get bad? And utilising the free resources. Through the ASIC website, you can check it whether a company is in existence, whether it's got an external administrator appointed, and there's even a little bit of an opportunity to see whether it's had previous external administration. So that can give you a little bit of a flag at a preliminary basis to say, okay, something's going on here. Do I want to be doing business with this company? And same deal with ABN lookup. That also allows you to see whether or not they are have an ABN, that they're legitimate. They haven't just made up a name. And the number of times that I've seen that where clients want to try and recover money from someone only to find out that it doesn't exist, that company doesn't exist. And also for GST purposes, making sure that they're GST registered. If they're going to be issuing you with tax invoices, making sure that that's legitimate as well and it's not a scam. Yeah. So really that's the retention of title. But also in the construction industry, if you are someone who are leasing out or hiring out on a dry hire, excavators, diggers, plant and equipment, if it has an undefined period, so there's been some changes since PPSA legislation have started, but currently, if you're leasing something out to a major construction site, it might be the roads extensions down at Bomaderry or what's happening at Albion Park, if that's going to be for a term of more than 2 years or an indefinite term, then registration is also required on the PPSR. So if you're in the business of hiring out goods, it's also worthwhile to have a chat. Because of the changes that have happened since commencement, the government's realised that there's it's a bit onerous to be requiring registration for all sorts of leasing. So they've sort of limited it down now to pretty well where it's 2 years or later. But it's worthwhile just knowing your position on that.
And I guess in relation, you touched on the types of searches that we can do, and Angela, you and your team are often certainly the ABR website in looking at confirming that, yes, ABNs are valid and the like.
Yeah, very, very simple to use. Serves us multiple purposes. It will tell you, like Amy said, whether or not it's actually just a trading name. It'll give you the type of entity. So is it a company? Is it a partnership? And does it exist? From a GST perspective, when you're confirming payment or that a tax invoice is actually valid to make payment. And one of the most common things we use, not really necessarily related to this, is when we're confirming payments to like subcontractors to confirm GST registration for the subcontractor reporting forms that are now required across various industries. So a really useful tool.
Yeah. And on the ASIC side of things, the free ASIC search will give you basic information. You can also go for a paid ASIC search, which I think is about $20. Which will give you a little bit more information in relation to the directors and the like. So in the event that we can't recover our money through our normal business processes, where do we go next?
Yeah, well, up to recently, or as of early this year, a statutory demand was a really handy sort of push if someone wasn't paying you. So it doesn't involve court proceedings. In the event that there's a debt that isn't the subject of dispute, so in the construction industry, for example, if you've issued a payment but there's a dispute about defects or they're holding back money because you haven't finished the job, that's going to be a genuine dispute. But in a situation where there's no genuine dispute and they just haven't paid you, a statutory demand is very handy. It's basically a letter that you send, and in the event that they don't pay you within 21 days, then you can take an application to the Supreme Court or Federal Court for an application to wind up the company. So it gives a company a real kick up the butt to be able to take your debt seriously and pay it. Now with COVID, that's changed. So previously, you used to be able to issue a statutory demand for a debt as little as $2,000. So it was a very quick and efficient way of, for the little guys, of getting the bigger guys to take the debt seriously. If the debtor actually had the money to pay it, obviously. If you're going to wind up a company that has nothing, then the process is pretty useless. But you had $2,000 in 21 days. COVID has extended that to $20,000 and 6 months. So you're still able to issue your letter or your demand, but you have to wait 6 months and wait until they don't pay you in that period of time before you can commence legal proceedings to wind up. So all is not lost on that front, but it just means that it flips the prospect of debt recovery around a little bit, where you might want to consider other options that traditionally statutory demands were quicker than, but now considering court action, for example, which I can talk to a little bit as well, if you like.
Yep, go for it.
So I guess, commonly now we're looking at local court proceedings. If the initial letter, and we generally suggest that you send a letter to your debtor request so not just your account rendered statement, but a clear demand that indicates that if they don't pay, that you will be commencing court action. That can be helpful because a court will want to see that there's an opportunity given to the debtor before it awards costs of the proceedings, rather than you just going off to court straight away. So for the sake of just sending out a letter of demand, as opposed to a statutory demand, a letter of demand just saying, please pay, and if you don't, we'll go to legal in 7 days, and we'll be seeking costs and interest, is the first step. Local court, you have a small claims division, which allows you claims up to $20,000, and allows for a very cost-effective way of trying to recover your debt. So you're not talking, any statements of evidence, etc., all done on the papers. So you're not having to get witnesses in there taking days at court. It's a very efficient process for debts that are under $20,000, and the filing fee is pretty, nominal. So for a small business, that can be a very effective way. And then once you get your judgment, you've got options of enforcing. By then, for example, the statutory demand procedure may have actually unwound. So it's back to your 21 days, which would allow you a judgment which is not a disputed debt because they've had the opportunity to put on a defence and be heard. If they don't pay that debt within 21 days, then at that point you could wind them up. In addition to other options such as garnishee orders, where if you've got details of their bank accounts because they've given them to you as part of their credit application to be able to deduct money from them. If they are then subsequently employed and you know their employee details, or the employer details, I should say, that gives an opportunity as well. So part of that process is trying to get as much information as you can up front as part of that credit application or new client onboarding as you can, because it may help you at the back end.
Yeah.
Over 20 grand is local court still, up to 100, but the process is just a little bit more formal, but still an effective way to get your money.
And does the process change in respect to the approach that you take with a company as opposed to an individual?
Yeah, generally with a company, you've still got the legal action, so you'd still be commencing proceedings against the individual. With the individual, though, you would be getting a judgment before issuing your bankruptcy notice because your debt hasn't crystallised. Whereas with a company, you can issue a statutory demand without a judgment. So as you can see, before COVID started, that was a very handy way. But the government has recognised that there needs to be probably a balancing for individuals and companies who are suffering economic hardship against the benefit of getting paid. The interesting thing will be, and I think you've had previous speakers on the issue, is what happens when the government stops this temporary relief getting into 2021.
Yeah. So, and as it stands at the moment, this temporary relief is in play until the 31st of December.
Yes. So, and it's part of a range of packages, including temporary protection for directors from insolvency. And I won't go into that today, but I guess for our purposes, it's really the debt recovery aspect that all is not lost. You don't have to sit on a debt. You can action it to try and enforce. But going back to my very first slide, checking the contract before you do, because if there's an excuse for that party to not have performed or not have paid you, then you don't want to be incurring the legal costs of starting proceedings like this.
Yep. And we've spoken about how the payment claims under the Building and Construction Act differs a little bit, particularly in the hire of equipment and the like, which is a really interesting point that I guess that the takeaway there is if you've got your equipment out to someone for, say, more than 2 years, effectively it's deemed to be theirs. Is that the way that
unless you've registered? So
yeah. before
you leave possession of those goods. Now, wet hire is a little bit different because your men's there and you're able to control that process. I mean, they can get in the truck or digger and you've got that control because it's your employee that might be there. But yes, it's the PPSR that you need to be registering on. The Building Construction Industry Payment Act, that is a mechanism to allow for quick payment for contractors. So I guess my point there is, even though the government has changed the other timeframes, for contractors in the building industry who haven't been paid, that option is still there, where you can issue a payment claim where they need to respond within 10 business days and pay the amount claimed. Otherwise, you've got the option of going to court or seeking adjudication under that act, with the idea that you're getting quick payment to be able to keep cash flow in your business.
So in the unfortunate event that we do end up with money that's owed to us that's not recoverable, from a tax point of view, Angela, what do we need to do?
Okay, so firstly, to write off anything as a bad debt, it has to firstly have been reported as income first, because the bad debt effectively negates the income. So whether that's in the current year or in a prior year. But then to get effectively a bad debt is a tax deduction for that income because you're not recovering it, not collecting it. So the debt actually has to be bad. So not doubtful, but actually bad. And to be able to get a deduction really depends on the facts of the case and what recovery action has been taken. So you actually have to genuinely try to recover it. And then the there are a couple of other little things that you need to be mindful of, in the sense of that there's a continuity of ownership test from when the income was actually declared, to then when you're actually claiming the bad debt, that there's still a continuity of ownership for a company to be able to claim it. But largely it's actually that you need to write off the bad debt in the income year, so before the end of the income year. So you would have to make a decision before the 30th of June 2020, and effectively write it off in the books of the records of the entity before the end of the financial year to claim it in that year. If you haven't done that, then you have the opportunity to do that in the following financial year. So it's really important that you actually have written evidence that you're actually declaring those as bad debts, that you've written it off in the books of the entity in the appropriate time frame, and then you can get the tax deduction.
And I guess the point there, that the very first point that you raised, in that you've got to have continuity of ownership in the company effectively in order to claim the deduction. So you could have a situation where a company's had a shareholding change for whatever reason. It could be an internal restructure, it could be an external sale. And if subsequently a debt goes bad, then that bad debt may not be deductible.
Yep.
So something really to look out for, particularly when drafting contracts where you're buying the shares in an entity as opposed to the business itself. And buying the shares in an entity is probably not as common as buying the business or the goodwill itself, but something to certainly keep an eye out for.
Particularly actually acquiring accounts receivable as part of that.
Yeah. So moving on, early in the pandemic, the federal government announced a code of conduct in relation to commercial leases, and that was closely linked to JobKeeper 1 in terms of eligibility and the like. Now that we're moving into JobKeeper 2, how has that impacted this I guess, code of conduct in relation to commercial leases?
Yeah, so there's been a new regulation that has commenced, which makes it a bit harder for lessees to get relief. So I guess taking it a step back, the regulation and the code of conduct allowed for what we call impacted lessees. If they'd entered into a lease before April 2020, or 24 April, I should say, 2020, to go to their landlord and say, look, I've had a reduction in revenue, and as a result, I need to renegotiate my rent for that period. So with the version 2.0, they've, I guess, tightened the requirements there. So you still need to have had an annual turnover of less than $50 million. So that, for the majority of medium and small businesses, that's fine. However, now we need to have experienced at least a 30% decline in turnover. So this is actual, not projected. So previously, pre-September and October, you needed to base it on projected. However, now it's on actual turnover. And that's in line with the changes to JobKeeper, and also has consequences for employees as well. So you need to have that 30% decline in turnover for July, August, and September quarter, and that needs to be relative to the 2019 period in order to now go to your landlords and say, I want a reduction in my rent because of my economic circumstances. That doesn't affect, if you've made that request or you've started the negotiations before the 24th of October, then the previous regime and the qualifications apply still. However, if you'd sat on your hands or your circumstances have changed and you need to go to your landlord and ask for that relief, then you need to satisfy the new eligibility test. I just make a point as well that if you've already started the negotiations, the extension to the 31st of December doesn't extend any agreement for you to have paid that rent that you might have already done a deal with on your landlord. We're talking about an extension generally of the ability of tenants to go to their landlord and ask for help. So at the moment, that's sort of the extension period that we're talking about. And I guess it'll be a wait and see to see in the economy if that needs to be justified to continue into 2021.
So just on that point, if I've entered an agreement I've had the rent deferral and I've agreed to pay that prior to the end of December. Just because these provisions have been extended doesn't mean I get to then extend the time period of my deferral.
Yes, that's exactly right.
Once you've agreed to that, it's locked in.
Yes.
And away you go.
Yeah.
And probably the other thing that we were talking about beforehand is that there are still other, if you're a landlord, other ways that you can, I guess, evict your tenant if you so desire.
Yes, and I guess it's important to note that the expectation is that from the Small Business Commissioner that the parties are working together and acting in good faith. So, for example, if a tenant or a lessee refuses to provide their turnover information, the regulation kicks in to say, well, tenant, you've been given that opportunity. Therefore, landlord, you're deemed to have complied with the obligations to consult and go through the motions. So there isn't an absolute prohibition on that landlord from actually being able to take action. They'll be deemed to have, if they've sought the information for a reasonable time and gone through that motion, they still will be able to retain their rights to evict that tenant. So the tenant, if you're a lessee, you need to comply and provide the information fairly to enable that landlord to be able to make that decision. But aside from that, if you trash the place, if you are operating, and again, go back to your lease as a tenant, make sure that your operating hours, you're complying with them, because that could be grounds for a landlord to issue you with a breach notice. If you've done renovations or alterations and you haven't got consent, if you've assigned the lease and you haven't got consent, other non-rent or money related claims will still they're not going to be frozen. So the landlord can still take action based on non-conformance with those aspects of your lease.
Yeah.
So it's not just a holiday from your entire lease provisions.
And I guess, as you said, permitted use could form part of that as well.
That's right. Yep. So if you don't have, if you've been operating outside of your permitted use, then that could be grounds for a breach notice to be issued and termination if you haven't remedied within the period.
Just turning to Angela for a second, we've lived and breathed GST turnover for the last, feels like 6 months now, but particularly more so with JobKeeper 2. And there's some anomalies in relation to the definition of GST turnover that not only affect JobKeeper, but then have flow-on effects to for people that are looking to negotiate under this code of conduct.
Yeah, so where a client's tenant is able to access this and they're getting in from the turnover decline based on certain percentages, they've actually been mindful that they actually look at the definition of GST turnover, because it's not strictly trading turnover, which a lot of people think that is quite black and white if they are doing okay or they have actually suffered. But one of the biggest anomalies, and particularly through JobKeeper 2, is that the GST turnover definition includes the sale of capital assets. So really it's the sale of plant and equipment. You've turned over your cars and you traded in a car and bought a new car. That trade-in of the older car, effectively those sale proceeds are included in GST turnover. So through something that's not necessarily planned, so some clients can get in because they just by sheer luck had sold some assets in the comparison quarter, and then there's some unlucky people who unfortunately may have sold some assets more recently to survive through COVID, and it's now in their test period, and then makes them ineligible. So it's really important to actually know what the definition of GST turnover actually is to make sure that you're eligible.
And what we're seeing is that there are some winners out of this, unintended winners, and unfortunately some unintended losers out of the way that those provisions have been drafted. So
yeah, lucky or unlucky.
Yeah. And then following on from that, if there is certainly a deferral or a waiver, that can have different tax implications for the landlord as opposed to the tenant.
Yep. So a waiver's effectively a waiver the rent payable is no longer payable, the rent receivable is not receivable. But with a deferral, from the tenant's perspective, that is still payable. It's just payable later. So in the current financial year that was actually incurred, we generally take that up as still as trade creditors, accounts payable, to claim the tax deduction in the year that's actually incurred, regardless that it's being paid later. The difference is that with landlords is that generally rent received is actually declared as income when it's actually received. So more from a cash basis. So it could be a bit of a, doesn't really line up, but the tenant can get the deduction and the landlord doesn't have to pay tax on that. So they actually physically get paid, which then does help them out.
Yeah, it's just an interesting one that we're seeing now as part of doing the 2020 tax returns, that these things are sort of coming up. Just a difference between the timing of when the income's declared and when the deduction's claimed.
That's important for the landlords. They haven't actually collected the cash to then unfairly be taxed on it, a whole year earlier.
Yeah, and I guess that would only change from a cash basis if the landlord is in the business of collecting rent, which for most small investors who only have one property, that's not going to be the case.
No.
Alrighty, so probably the last thing that we're going to have a look at today is the impact on employees. So as I said, we've moved from JobKeeper 1, and we're now into JobKeeper 2. Certainly, our experience within our client base is about 2/3 of the clients that were in JobKeeper 1 have actually made it into JobKeeper 2. And that number surprised us, to be perfectly honest. We didn't think it would be as high as that. But what we do know that like the rental code of conduct, there were some provisions that enabled some flexibility for employers in relation to employees that were based on their eligibility for JobKeeper. And now that we've moved into JobKeeper 2, how have those JobKeeper enabling directions changed, Amy?
Well, basically from 28 September, there's a change. So you've got to be looking at that new ability to qualify based on the actual turnover test, similar to what's being applied for your commercial tenancies. There is scope though for legacy employers. So a legacy employer is somebody who was previously entitled to JobKeeper 1 under the previous qualification arrangements, but is no longer able to qualify under the new arrangements, but can establish that they've suffered a 10% reduction in turnover. And to that end, there needs to be support for that. So it's not a case of an honesty system. They need to be able to provide through a turnover certificate that, and that's where, talking to your accountant is very valuable because you need to be able to substantiate your basis. Then on that basis, they're able to give a form of modified JobKeeper enabling direction. And what I should say is that JobKeeper enabling direction is the ability of an employer to give a direction to your staff that might be inconsistent with what was previously in their award, in their enterprise agreement, or even under the Fair Work Act and the standards. So, for example, you might be able to tell your employee that the duties, if they're a receptionist, that they may need to be doing sales, so the idea being that they need to muck in and assist the organisation as it's needed and to be kept busy. Changes in days, changes in hours, and as well as a stand down direction to reduce the period of time in which they're going to be at your workplace, and also the ability to give them a direction not to come to a particular or to change location. So where they may have been going to a particular workplace or branch office, the ability to be able to say to those employees that actually we need you at this location instead. So it can be incredibly valuable to have that flexibility. I know particularly during JobKeeper 1, where businesses were suffering that immediate downturn, having to be able to reduce that requirement for employees to be turning up to work was very helpful, or to change their duties was very helpful for their organisation.
So if I qualify for JobKeeper 2, I'm effectively entitled to these enabling directions moving forward.
Yep.
If I'm not entitled to JobKeeper 2, but I have a 10% decline in turnover, I still
Yes.
can get in that way.
You can, yes.
Yep.
Yeah.
And like Angela mentioned, that 10% decline in turnover is GST turnover. So we've got to be mindful of our sales of assets and all of that sort of stuff.
Yes.
So if we manage to get past those two criteria, as you mentioned, the things that we can look at doing,
Yes.
which
So
ultimately build around added flexibility, just to
yeah.
get by, I guess.
Exactly. And we're not talking about employers trying to take advantage of their employees here. We're looking at just giving that genuine flexibility to be able to change and move course in response to whatever your current market needs of you.
Yeah. And then just to cover off on that, some of the I guess obligations of the employer when they're looking at enacting those directions. What are some of the things they need to do there?
Well, they need to direction. Consultation is a big thing. So consulting with your employee, rather than just giving them a direction that instead of being in Wollongong, you've got to now travel to Sydney. Or instead of doing a usual job, you're actually going to be the cleaner in the organisation or doing additional cleaning duties. So having that consultation, you need to be reasonable. So you need to provide justification for your need to give these form of directions, and you also need to formalise it. So it's not good enough to have a general conversation in the hallway or a direction, but it should be in writing and put on that employee's personnel file. So that there is a clear record of what the direction was. And it's important to note as well that if situation changes and you're no longer, particularly in the legacy position, where you're no longer suffering your 10% actual turnover reduction, then your enabling directions will cease. So it's a case of watching that space to make sure that you're complying with the law, having regard to your turnover.
So as soon as you breach, or as soon as your turnover ceases to reduce by 10%, you're back to normal operation.
That's right. Yeah.
Yeah, and that's not tested at the end of a particular period. It's just
no. I think it goes based on an assessment based on honesty of the employer there.
Yeah.
Of course, if it went to court because you've given a direction and the unions get involved, you can very much expect that you will need your documentation to back yourself up for your decision making.
Yeah, and that's one thing that we have been, quite diligent on when working with clients, particularly in relation to the JobKeeper, is making sure they do have all the relevant documentation. That the calculation and the reduction of turnover is there. It's evidence based, because what we're now starting to see is the ATO, in particular, is starting to have a look at some of these JobKeeper claims going forward, and are going to be relying on clients' records. So. We took the approach early on to make sure that all of those things were covered off on in the event of a review. And what we're seeing now is that they're starting to happen. And I guess finally then, there is an end date in relation to these.
Yeah, absolutely. So 29 March 2021, unless we get a ramp up of COVID and we have to reassess and the government takes steps accordingly. But for now, we need to treat it on the basis that that's our date.
Yeah. So when when it comes to employees, what are some of the things that we need to consider, when we're planning ahead, when we're putting on new employees or drafting new agreements?
I guess there needs to be a recognition that you're not necessarily going to be entitled to JobKeeper enabling directions. So, I'm aware you've got various incentives at the moment encouraging businesses to take on new employees and the incentives that increase their overall headcount. So with that in mind, these are always things to keep in mind, but I guess just particularly as we currently stand, enforcing your probation period. So you have a 6-month qualifying period, having that hard conversation, diarising that so that if that person is not working out, not being afraid to part ways at that point, rather than letting things drift and having to rely on performance or a genuine redundancy later on down the track. And in the case of your small business, that 12-month period is important as well, because an employee who's been with you for less than 12 months is not entitled to redundancy. So just making sure that you're aware of those timeframes and having open conversation and dealing with issues early on in terms of non-performance, but also probation periods allow you to let go people that for no reason. So that can give you very nice flexibility. If you're putting on people now, you've effectively got 6 months over a period of time where there is going to be great uncertainty to be able to work out whether that employee is right for your business. But don't let it drift. Considering the type of engagement, you may decide to go for a fixed term, for example, which may, allow you to employ them on an agreed period of time rather than on an ongoing basis. But in order to do that, you'd want to make sure that you've got the work for them for that 6-month period or 12-month or 3-month period. Casual use of casuals, but obviously if it's going to be regular and systematic, so they're really not a casual, you can't get away with calling them casual. So just keeping that in mind and having regard to the wider alternatives that are available from the government at the moment through traineeships. There are various providers that are offering incentives in that space. So considering the wider options that are available to you there.
And you mentioned redundancy before, and there's different rules in relation to whether the business is deemed to be a small business.
Yeah, and look, for a lot of my clients, making sure they're sort of around that 15 employee mark. So it's just worthwhile before you're taking steps to work out whether you actually are a small business. So that is based on people in seats, not full-time equivalents, part-time equivalents. So 15 people in your business. It excludes, though, your casuals. Now, these are not the same casuals that turn up every Monday, Wednesday and Friday and do the same hours. That's regular and systematic. They're counted. But if you're talking about genuine people who are out there floating and coming on an as needs basis, they won't be counted in your small business count. So it's just worthwhile to, before you take that action, have a look. The other thing is, if you're running corporate structures where you may have one organisation that's employing a certain number of, or one company that's employing a certain number of people, and then a related entity that's also employing another amount of people, they will generally be counted together. So you can't get away from, not being a larger business by hiving it off to multiple companies in that regard. So yeah, just be mindful of that. And I guess if you do have performance issues, as opposed to it just being convenient for you to terminate someone during their probation period, there is a thing called the Small Business Fair Dismissal Code, so that if you are a small business and your employees are not performing, have a look at that, follow the processes in that code, and that will give you protection in the event that there is a claim made by that employee. So that's really important, just to be aware of that. Just park that information away in the back of your space, that if you are dealing with a non-performing employee, that there is a code there that you need to follow. If you don't, you could find yourself the subject of a claim.
Yeah, it's really important. I guess it all comes back to and documenting everything you do. That's our experience has been, particularly in employment matters. Just make sure you've got all your documentation there.
Absolutely.
It's really important. Just turning to you quickly, Angela, if we were going down the path and we were required to make an employee redundant, there's a number of tax things that we can consider in terms of how we calculate that final pay.
Yeah, so it's very important to actually do the calculations and get them right. And there's multiple parts that make up a genuine redundancy. So things like paying out their unused annual leave and long service leave. So they're capped, the tax rate on those are capped. On termination, they're not ordinary times earnings. So they don't require superannuation to be paid on those. Then there's potentially like the payment in lieu of notice, where that is actually ordinary times earnings and does require superannuation on it. So if you saw somebody to use their leave whilst they're technically still employed, and then at a later point in time decide to terminate them, that while you're actually on leave and employed, you're actually still accruing leave and pay super on it. But if you actually form it as part of the genuine redundancy, then they'll be taxed differently. And just to know that there actually are caps for different components of the genuine redundancy, rather than necessarily being at normal marginal rates. So it could actually save the employee a bit of tax as well. And it's the difference between the genuine redundancy versus somebody else, like a normal redundancy, and so forth. These are for the genuine redundancies because their position is technically no longer available.
Yeah, so there are, one, it's a complicated calculation, and then two, there are a number of ways that can be potentially structured to give the best outcome for the employee. And I think particularly when you're looking at making someone redundant, if you can structure the payment in a way that maximises their benefit, then that's, I guess, some consolation to that employee.
Yeah, and there's also tax-free components based on their period of service, the number of years of service as well. But you just need to make sure you get the calculation right.
Yeah. Okay, well, that's where we'll leave it there today. We've gone through an enormous amount of material. We'll probably have to watch this one over again just to make sure that I remember all the issues that we've come across. But really like to thank both Amy and Angela for joining us today on the webinar. There's been, as I said, plenty of information, lots of practical tips to navigate through. But I think more importantly, it is important to seek advice in this area. It's not straightforward, it's new. And seeking advice from experts in the field will often save you enormous cost in the long run. So Amy's contact details are there on the screen. Please feel free to reach out to either us or to Kells if you've got any further questions. We do quite a bit of work with Kells for mutual clients, and we enjoy working with them, and they certainly know their stuff. So thanks again, Amy, for joining us. We really appreciate that. Next week's webinar, which is our penultimate webinar for the series leading up until Christmas, we're going to look at small business grants and sort of what the funding and incentive packages that are available to small businesses. So we'll be joined by Peter Masterton from Oz Industry, who will, I guess, let us know the different opportunities out there for funding that have emerged at both the state and federal government level. And Peter will be joined by Gary, who's had substantial experience in this area, particularly with his involvements in the startup businesses out at the Innovation Campus. So we look forward to next week's webinar. Again, thanks for everyone for joining us this morning, and I hope you have a good day.